Vamachi, thank you very much for that. Right in queue, markets opening. We are opening slightly higher, about 0.15 up on the Nifty. The Nifty Bank also similarly about 0.15 higher. And mid and small cap indices will come up on your screen as well. The Sensex is up, all up, but small up. That's I guess the way to put it. 2:1 right out of the gates, advances to decline ratio. But that'll tend to move around as we go through the first few minutes and then through the course of the day. Nifty heat map coming up on your screens. 50 points, 55 points, 24,681, more up than down, definitely. And you've got HDFC Life on one end and there's Infosys on the other end. But it's more up than down to begin the session. Small cap index is clearly, leading with a 0.5% gain. And the mid cap index is also doing better than large. So broader market's doing better to start this session. Surabhi.
Okay, Reliance is leading from the front. It finally comes out of the shadows. After the AGM, it had a rough day. But this morning, it's up about 1%. By the way, there's a Morgan Stanley call on Reliance. MS is quite optimistic. Their target is 1701. And they say that the anti-involution story and the AI story is going to redefine the destiny for Reliance going forward. So that's a stock in focus and doing very well this morning, helping the overall market. What else? HDFC Life, 1.5% up. Eternal is putting on some weight, 1.3% higher. Coal India, after those numbers came in, production numbers, 1% up. BEL has announced order wins of about 600 odd crores. That stock's higher by about 1% or so. SBI Life along with HDFC Life. So the life insurers are doing well today. Bajaj Finance is up. There's some buying on HUL and Tata Consumer and Titan. So those are some of the consumer names that are doing well. But really, it's a Reliance story, almost 1.5% up on the stock. In fact, we'll put up the details of that Morgan Stanley note for you in just a bit. On the flip side, Infosys is cooling off after yesterday's run-up. There are not too many stocks falling, actually. Axis Bank is down 0.5%. ICICI Bank is taking it easy. Overall, the Bank Nifty is showing a small, slip of red right now. And some auto stocks like Maruti are cooling off, even Tata Motors. So some auto names, M&M also. Auto is cooling off after the recent run-up. Banks are quiet. It's Reliance all the way. That's the large cap story. Nigel?
Well, that's right. I think the stocks actually that are making the big moves today are the sugar-related names. And the update that came yesterday is the government has allowed the production of ethanol from sugarcane juice, syrup and all types of molasses without any restrictions on volumes. I think that's what's got the stocks excited. And, there's this big move that we're seeing across the board. Balrampur Chini, even smaller companies. If I look at Uttam Sugar, I look at Sri Renuka, that's up more than 10%. Shakti Sugars, whatever's left, it's up only 8.5% now. So all those sugar-related names, they are bucking the trend today. That's clearly the sector of the morning. We'll have to see how much of a financial impact will it have. Because as of now, it appears that it's more sentiment in nature, but we'll wait for further clarity on that front. Cross, KROSS, that's up close to 7.5%. Massive move is what we're seeing out there. Ola is saying it's not yet done. Stock continues to move higher as well. That one's moving on very, very large volumes. So big up move is what we're seeing on that particular name as well. Hindustan Zinc as well opened in the green. I think we should keep an eye out on that one. A good move is what we're seeing on that stock. So a decent start, up 40-50 points, right in that resistance zone of 24,650 to around 24,700. The Nifty Bank yet again doing a relative underperformance.
40 points on the Nifty, so 24,667 is where we are at right now. We've got, actually it's a lot of sugar as Nigel was pointing out. Mobikwik is the other one, which is up about 4% or so. Something like a Gokuldas bombed out, right? From 1,200 fell straight to 700, less than 700. 726, about 4% higher on Gokuldas. One of the big textile casualties on the back of course, the Trump tariffs and other stuff coming up as well as we begin the session. On the downside, actually, it's 3:1, advances to decline. Ixigo is the only one I can see which with a 3% cut and some volumes as well. Otherwise, stuff which is down small and not really backed by any significant volumes right now.
On sugar, I just wanted to add that this has happened after a while. The fact that sugar and molasses, all varieties of molasses will be allowed for the manufacturing of ethanol. Yeah. And this takes away some of the industry concerns of maybe too much production because we've had bumper monsoon now for 2 years in a row. So with the diversion being finally allowed, it perhaps alleviates some of those concerns. But we'll have more for you coming up later.
Yeah.
But literally the sector of the morning, I mean, even Triveni Engineering, Balrampur, Triveni, Praj, Sri Renuka, everything, Dalmia Bharat, Bajaj Hindustan. If it's sugar, it's looking sweet today.
Well, that's right. And the other one that's moving along is Mobikwik. The stock is up close to around 5%. Keep in mind, the high that the stock hit earlier this year was around 700 rupees. So actually, the stock had come down to less than a third of what it was at its peak. Now it's moved up because there was an overhang with regard, to that fund, Abu Dhabi investment holding close to 2.1%. That's out of the way. The street was waiting by for that. If you look at it on valuation parameter, well, the stock trades at around 1 times EV upon sales. It has cash in the books, but they're burning cash as well. Though the path to profitability is something that the street will track over the next few years. So a relative underperformer, block deal going out of the way, some of these new age themes back in focus and guiding for better times ahead. I think the street is taking note of that, and that's why the stock is up 5.5%. But we'll have to see how much is sustainable.
I remember, I think Nilesh of Envision has been a long-time fan. I think so. We've spoken to him on Editors Roundtable, and maybe, I don't know if he'll have a view, but we'll try and get that going for you. Just some more opinion on where this one goes. I mean, it's come off a long way, and sometimes these things, like for example, what we're seeing with Ola, right? Like a one-way 50-60% move, but very, very quickly. Rahul Arora is CEO at Nirmal Bang Equities. He's with us. Rahul, good morning. Great to have you with us here. Thanks very much for your time. So let's just start with, I mean, what are your thoughts on this GST meet from tomorrow, and how is positioning now, and whether some stuff in terms of price gains after the meeting and what is done, will it be a durable move? Is it tactical? Is it already played out? Just your thoughts around this subject.
Morning, Prashant. Thank you for having me on the show. So, of course, there's a lot of anticipation, and I think, there's a lot of talk about deferred purchases once those GST cuts effectively come in. But my sense, Prashant, is that even if it comes in, I don't know how much of it will be structural in nature. Of course, you'll have to look at penetration levels and where things are with respect to durables, electricals, air conditioners, even for automobiles for that matter. So this could potentially give you a one-time kicker over a period of a year, but I don't know how structural it will be from that perspective. And then, of course, this is coming at a time just before festive. I mean, technically, if you want to go back to Raksha Bandhan, we've been in festive for about 3.5 weeks so far. But I think the fact that, this is coming right at the bang middle of the festive season, I think there might be some deferred purchases, but it might sort of trickle into the October, November, December quarter. But that being said, Prashant, I think, valuations have caught up in some of these places. I think they have been quite sharp after these announcements. Let's not forget that the first quarter results for some of these sectors were not that good. Particularly in the cooling segment in durables and electricals, there was a price correction, and they've started looking attractive, but I wouldn't buy them purely from a GST cut perspective. I think some of these names like a Havells or a V-Guard or an Orient or a Blue Star look structurally good to us. One-time benefits will certainly help, but I think overall also, Prashant, if you look at the market valuations, they're not all that cheap. Of course, what's happening with the SCO summit is going to help in terms of soothing the nerves, in terms of whether there could be certain trade negotiations over the next 1 month or so. But at 24,500, 25,000, if you look across sectors, buying IT services, I don't think there's too much screaming value that's emerging in the market right now. So specifically to your point, I'd wait and watch. I would certainly expect a pop, more of that probably in the October, November, December quarter. But valuations are looking fairly reasonable in some of those sectors and even beyond that for now.
Okay, Rahul, hi, good to have you in. So that's the question, right? As these cuts trickle through, whether it'll be more than just a bit of a tactical trading pop in terms of stock price. Whether you talk about autos or whether you talk about FMCG, I mean, tactically, yes, because the market has been underweight or neutral in best case on this sector for a very long time. Do you see a more material structural shift after the GST cut, or is it just going to be a trading rally at best?
So on consumer, certainly not, Surabhi, because I don't think you're in an era where, of course, you've had rural that's done well. You've heard that from most FMCG companies that the rural commentary has been better than the urban commentary over the last 3 to 6 months. We're obviously going into a very important state election in about 3 months in the northern part of India. So maybe to that extent, some doleouts may continue. But my sense is when you're looking at consumer, even if you get these GST cuts, you're not looking at a structural 5% plus volume growth in most of the large mature FMCG companies in India. And this would include foods, barring, say, something like a Nestle or a TCPL, or maybe a Britannia on a case-to-case basis. But if you strip those three out, I don't think you're looking at a structural 5% volume growth or beyond. Now, in that backdrop, to be paying 45, 50 times price to earnings multiples, I'm not so sure. To the point I was making to Prashant a little while earlier, I think if you look at names like V-Guard, Crompton, Havells, Blue Star, these are names that saw a bit of a correction. The first quarter was a washout for these guys. You did have a slightly cooler summer. You did have unexpected rains. But I think if you look at market share gains for most of these players, they're fairly good. I don't think there's anything materially concerning. I mean, let's keep these GST numbers aside. Even without these, we're expecting 15-20% growth in most of these companies over the next 2 to 3 years with some amount of operating leverage and margin expansion. And most of these companies, if you just say Blue Star, on the durables and electricals, if you keep Havells and Blue Star aside, most of these are coming to you between 25 and 30 times. So there's been a bit of valuation reset. The industry leaders are still coming at a premium. We would have to expect moderate returns from there. But I think if you're looking at outperformance, I would probably still look at more on the automobile side, particularly two-wheelers. And I think we're seeing that in the monthly sales numbers as well. iShares is on a different planet. We've been discussing that for a few months now. I think the export side of the business for the other two-wheelers are also picking up, albeit on a low base. And I think the EV numbers are also very heartening. So I think if I was to play GST from all of these, I'd probably play it through some of these electrical players and auto, as opposed to playing it through plain vanilla FMCG.
Electric players and auto. What about the EVs? They have suddenly come back. Ola 40 to 60 in a matter of a few weeks. You have Aether as well that has done quite well. How would you play that theme?
So obviously, Nigel, you've had launches right up to, a day or two back. And, some of the players are talking about 40% EV adoption in the next couple of years. I think Mahindra has been killing it with its EV. And I think the others as well that have put the product out in the market, even the Tatas are doing extremely well. I think the base is very low, Nigel. So the percentages will look higher, but I think it's a theme that's catching up. I don't know as a percentage of total volume how much these numbers will look like in a couple of years from now. But even if you look at the base numbers for most of these players, they're not doing too badly. I think if you look at Mahindra, the tractor numbers are still growing at 8-10%. The rest of the portfolio volume growth is still at about 10-11%. Even if you look at a Hero or a TVS, they're still managing to grow 8-10% without the EV kicker. So I think the base business itself is doing well. This could be the cherry on top. I don't know about that 40% EV adoption number that some players are talking about in the next 2 or 3 years. But it's certainly a space to watch. And I think, on the PV side, I think Mahindras and Tatas are killing it. And I think even on the two-wheeler side, you have some of these new age companies. But I think the incumbents will catch on. I think, both Hero and Bajaj and TVS, in fact, all three of them have been doing work to this effect. But I think it could be an interesting play, but I don't think it will be a material swinger in terms of overall volumes over a 2-3 year period. In this space, our preferred pick would still be, say, M&M on the large cap space in the automobiles. You'd play iShares on the two-wheeler space. And if you're playing it through auto ancillaries, we probably play a proxy on the two-wheelers through something like an ASK Automotive.
Okay, got it. All right. So Mahindra, ASK Automotive and Eicher Motors. Rahul, what about the banking names? Banks have underperformed big time just in the recent past, from being the consensus buy at the start of this year. Now, you have preferred some of these other smaller banks. I think CUB, Federal Bank, AU Small Finance, those are the banking names that you've preferred. Do you continue to maintain that positive stance? How are you viewing the BFSI space? What do you like?
So I think, Nigel, there are 2 or 3 challenges with the banking sector right now. The first being valuations. I think if you look at, say, let's take the large private sector banks in the company, HDFC Bank, ICICI Bank, Kotak Mahindra Bank, all are trading at 2.5 to 3 times price to book value, which was not the case 12 to 15 months back. They were probably trading at much lower valuations. In fact, some of these were even trading at 2.1 times. So one is valuations are a challenge. The second is the CD ratios for most of these companies. They've probably been north of 90%. And you're seeing HDFC Bank is deliberately slowing down its book so that it can manage its CD ratio. So I think that's the other challenge that you have. And third is genuinely credit offtake is very slow in the system. I think if you look at the sectoral deployment of credit numbers that come out, and we just released a report this morning for the last fortnight, you're not even having 10% growth. I think if you look at agricultural credit, services credit, industrial credit, these are all growing at just about 5 to 7, 8%. You have retail at about 10, 11%, but you're not looking at a situation where credit growth is going to be very strong. So valuations, credit growth, and CD ratios are a concern. That being said, if you look at a State Bank of India, whose CD ratio is somewhere around 77, 78%, ROEs of 13, 14%, ROA of about 1.5%, coming to you at less than 1.5 times price to book, that would probably be a screaming buy for me at this point. You alluded to City Union Bank, again, a name that we've liked. I think 14, 15% growth. is a certain given there. Also, Nigel, I think we would also branch this out to, say, housing finance companies. I know something like a home first comes to you at 3 times price to book. But I think if you look at the growth numbers, we're projecting about a 25-30% kind of growth for a home first. And the other name, which is not very widely tracked, which is Housing Urban Development Corporation, HUDCO. Again, an 18-19% ROE business, about 2.5% ROA coming to at about 1.5 to about 2 times book. I think that could be a very interesting space. Of course, HUDCO is branching out into other infrastructure projects, but I think SBI would probably be our top pick to play in the banking space, followed by City Union Bank and a couple of these home finance names like HUDCO and Home First. But I think, Nigel, if you're looking at it as a sector overall, you'd have to have slightly tempered expectations given where valuations and CD ratios are.
Okay. Rahul, don't usually ask you a stock-specific question, but this is, I mean, the stock is more like, a huge part of the market, Reliance, because there's so much moving on, right? This morning there's a call from Morgan Stanley. I think the market's taking note of that. The target price is 1,701 on the stock, and they think that Reliance can be a big beneficiary of a move to reduce unhealthy competition, whether it's for their own business here, tariff. We've seen the tariff improvement in Jio, or whether it's overseas. But your thoughts? I mean, Jio's IPO got announced, but then there were concerns about a holding company discount because it may not be a clean demerger. So, what happens from here on? It's a big stock.
It is, Surabhi, and I think the reliance on Reliance, apologies for the pun, will be far more because of what we've discussed about FMCG, banks, and IT services. Because this fourth cog in the wheel makes up about 75% of the Nifty, and I think a lot of the heavy lifting will have to be done. I think the AGM was a remarkable event. I think what they're announcing in terms of new initiatives is trying to decrease the overall contribution, the EBITDA contribution from the oil and gas business. I think Reliance 5 years from now could be a very different company, just like Reliance today is a very different company than what it was 5 years back. And I think the fact that they're trying to decrease the EBITDA contribution from the traditional energy business is a remarkable, testament to their execution capabilities. I think it's not just Jio. So, of course, Jio will list, and I think it's practically a duopoly in the market as we speak, or at best, the third player is not a very strong competitor. So I think the valuations will hold out regardless of the holding company discount. But I think if you look at the other businesses, which is retail, and the kind of disruption that it has done to the existing incumbents and not allow new competition to come in. And there are various aspects, Surabhi, that Reliance has not even gotten into. Say, for example, food delivery. It has acquired Just Dial. It has such a large captive base of customers through various businesses, including media, that it has not even entered into the territory of Swiggy and Zomato. So Tira is another business where you haven't seen a big scale up compared to what Nykaa has done. So I think and of course apart from the digital initiatives that they spoke about at the AGM. So I think where valuations are for Reliance right now, it is not an unreasonable place to buy it. Of course, given the changes that are happening in the company, I would say this is a company that will probably compound at about 10-15% in terms of a CAGR of stock earnings over a period of time. But even that for a company like Reliance is going to be quite magnificent given its market capitalization. So I think if I was to look at the 4 buckets of the market that contribute 75% to the Nifty, I think Reliance for me at this point would be at the top of the pecking list, say maybe followed by IT services, banks, and then FMCG.
Okay, the reliance on Reliance, and it's surely working out this morning, because if you remove the move that RIL is contributing 2%, then the Nifty would have been a very, very different picture, because not much else is fired up this morning. Rahul, good conversation. Thank you very much. You have a great day, and we'll look forward to connecting again soon. But yeah, before we move on, talk about more stocks, looking at things, it's Reliance, it's Eternal, and there's actually a bit of a consumption play once again. Nestle, Tata Consumer, HUL took a breather yesterday, but it's back up. So Reliance, some of these FMCG names, not too bad.
Okay, all right. Let's focus on a couple of names then that are moving around. Phoenix Mills, you had a Motilal Oswal note that came in earlier today, and that stock is clearly reacting to that note. Sudarshan joins us to help us out with more details. Sud?
So Motilal Oswal has upgraded the stock to buy, and target has given is of 2,044, implying an upside of almost 35% from current levels. It believes that commissioning of new malls will be driving the growth even beyond FY27, and it estimates 21% CAGR in retail rental income over FY25-27 to reach almost rupees 2,800 crore by FY27. Even office portfolio is going to surge almost 3 times. And for hotel segment, it believes that it's expected to benefit from strong momentum. So stock had started with a gain of almost 3%. Even currently, it's up almost 3% as well.
Yeah, no, absolutely. Sud, thank you very much for that. I just want to highlight what's happening with the sugar stocks before we sort of take and go further. I mean, you got about 8-9 of these stocks which are really charging strong. I mean, it's like a sugar high, right? Renuka will come up on your screen, 13% higher. Dwarikesh, there is Dhampur, there is Shakti Sugar, KCP, Kothari, Balrampur, Bajaj Hindustan, Ugar Sugar, KM Sugar, Dalmia, Triveni, I can go on. Anything between 5% to 20%. Some of them, of course, are limit up, as you saw earlier on your screens right now. So it's a big mover right now. And Ria is here with details on what has happened, what is triggering this move. Ria, over to you. Take it away.
Well, yes, the reason all of these sugar stocks are surging in trade today is that the government has now removed all curbs on ethanol production from sugarcane juice, sugar syrup and B heavy molasses and even C heavy molasses for the upcoming sugar season. Now, the government is going to periodically review the diversion of sugar for ethanol production to maintain the availability of sugar for domestic consumption. Now, remember, these restrictions were earlier imposed in December of 2023 due to rising sugar prices, and now this move is a very significant relief for the entire industry, and sugar mills will now be able to use the lying inventory that they have of B-heavy molasses, and this is also going to help achieve the target of boosting the proportion of fuel in gasoline blends to 20% as per the target set by the government earlier. And in a separate government notification as well, they have also now allowed distilleries to purchase up to 2.3 million metric tons of rice from the FCI for ethanol production. So all of this is positive for the industry, and the stocks are resultantly higher in today's session.
Okay, all right, got it, Ria. Thank you very much for that. So sugar in a sweet spot this morning. Let's move on to our next conversation, and we have Aadhar Housing Finance on our radar. The company did report a fairly healthy set of numbers for the first quarter. It saw strong AUM growth. And of course, it retains its expectations of double-digit growth for the rest of the year as well. Rishi Anand is with us, and we are going to be focusing on three main points in this conversation. So let's lay them out for our viewers. Number one, what happens to spreads in an environment where we've seen some interest rate cuts? Will there be more pressure for the rest of the year? Number two, can the strong disbursements in the first quarter act as a proxy for the rest of the year as well? Could it be a better than expected year in terms of AUM growth? And finally, we want to understand what could drive ROA expansion from here on. So let's take it forward with the guest. We have Mr. Anand with us. So Mr. Anand, let me actually start this point with growth, because there you've done so well. I mean, with your AUM, you've still managed, I think, 20% in the first quarter. Your guidance, I think, is 18 to 20%. But how does it look? Because you also have the PMAY, the next tranche being rolled out. And, given the tax cuts that have been announced, whether it's income tax, GST, I mean, generally there seems to be a sense of more buoyancy out there in the market. But you tell us whether you expect even better demand for affordable housing, and what would your expectations be?
Thank you so much, Surbi, and very good morning. You're right, our first quarter numbers have been better than expected. If you remember, our indication has always been 20 to 22% growth on AUM, 18 to 20% growth on disbursement. What we've given in quarter one is 22% growth on AUM and about 32% growth on disbursement. Numbers were stacked very well. From here on, the industry is doing fairly well. We have very good expectations from the industry. The regulator and the supervisor are putting in all the efforts on the supply side, which will ultimately result on the demand catching up. From an indicative perspective, we will maintain our guidance of 20 to 22% growth on AUM, even on a large balance sheet of 26,500 crores now, and an 18 to 20% growth on disbursement.
So that means that there is a chance, a good chance, that your AUM, by the time you end the year, it crosses 30,000 crores?
Hopeful, very hopeful. But from a purely guidance perspective, if you look at our numbers and the kind of indications we've been giving, we should be doubling our numbers in 3 years from now.
You mean the total book doubles in 3 years? That's what you're saying?
3 years, close to 50,000 crores.
Just as an aside, Rishi, hi, good morning.
Good morning.
Someone said 15,000 crores, or maybe it's 10 to 15,000 crores is like that level which is the escape velocity for housing finance companies or NBFCs. After that, it is, to cross that is hard, and then it becomes, it's more of a trot. I don't know if that is the correct way to look at it, but you're past that level. I mean, you left that level behind some time back.
Yes, I remember, Prashant, having detailed discussion with you when I was in your office and that time I remember we were at 11,000 crores of book, and you asked me this question of whether low-income housing finance companies like us will be able to cross 15,000 crores. So did we? Then the question on the table was 20,000 crores. So did we? And we are now 26,500 crores. I don't see any reason why companies which are which are completely focused on one segment should not grow, because the demand is there, the supply side has been acted on. Surbi spoke about PMAY, that has been kicked off. In fact, we are the fortunate ones to have rolled out the first PMAY to the customers. We've clocked about 11 crores of subsidy already given in the last 1.5 months. So things are looking good, and hopefully we will be the first company to reach the number that I spoke about in 3 years' time.
Actually, within NBFCs, Rishi, I think housing finance is the more durable kind of, steady growth kind of segment, right? Low NPAs and historically speaking. But it's interesting you said companies focused on one segment because now, at least last few years, we've seen the era of sort of kind of sector champions. Everybody's doing everything, but at least from an NBFC perspective. But housing finance, I mean, HFCs are focused on HFCs in that sense, right? I mean, broader NBFCs seem to be in too many segments.
Yes, yes, you're right, Prashant. And within HFCs also, of late we've observed a lot of HFCs wanting to go into multiple segments. So, within HFCs, the segments of prime, affordable, low income, and we've observed that a lot of companies are wanting to get into various segments. And that's where, Aadhar stands out and say, we've always maintained the stand that we will only focus on the low income segment. We will only focus in the EWS LIG. We will not go into other product lines. And maybe that's the reason why we are giving, even on a high balance sheet, we are able to give higher numbers.
All right. Hi, Rishi. Good morning. Good to see you. And let's focus on two aspects. One is on the spreads and one is on the ROAs. The spreads have come down to around 5.8%, hovering around that mark. However, there'll be a reduction in cost because, the bank lending cost as well will come down. So how do you see spreads pan out, say, in Q2 as well as Q3? Point number one. Point number two, on the ROAs, it's at around 4%. You have been guiding a 20 to 30 basis points improvement from year on. So you could tell us the top 2-3 levers that you have with you. Could it be better NIMs? Could it be lower capex, lower credit cost? Comment on both these two.
Okay, so Nijel, morning. On spreads, if you remember and recall our last conversation, I have maintained a stand that we will be a company always for the next 3 years, which will be a spread upward of 5.5. Today we are at about 5.8. The cost of fund, the benefit that is going to come to us over a period of next couple of quarters. The good part is, or I would say the otherwise also, we do not get any serious advantage on reduction of cost because 76% of my liability and coincidentally 76% of my asset side, both are floating in nature. So whatever comes in either ways, rise in cost, drop in cost is passed on to the consumer with a gap of, let's say, 1 quarter because you need a quarter to operationalize things. So I would still maintain the stand that we are today 5.8. Down the line, anywhere 5.6 and upward is what we are going to be maintaining. As regards ROA, you're right. We've been a 4% company. I think stable state, as we move ahead, the company should be an delivery of about 4.2 with an ROE of 18% couple of years down the line. That's the stable state that we would want to maintain. A couple of levers. OPEX obviously plays out, productivities play out. I would not say cost will play out much. As I told you, 76% is in both ways is floating.
All right. Rishi, final question, not so much on the operations, but what about your tenure? I think sometime in the next coming few months, it expires, right? There is some uncertainty among the street. Could you tell us what is the outlook? When does it end?
So my tenure ends in January 27. So I have 1.5 years to go. And hopefully the way things are going, I'm sure, I will be looking at being stable in the organization.
And is there any buzz, Anup Kumar Saha, he moved on from Bajaj Finance. There was some buzz that maybe he could be coming on board to strengthen the management. You want to comment on that?
I don't know. These are
Any truth, or is it totally rumors? You could dismiss it, or you could tell us. Maybe in the works, maybe not.
I would neither want to dismiss, neither want to tell anything on this. But these are market rumors. The management right now is very stable. In fact, I don't know whether you are aware of it or not, that the Blackstone has rolled over its fund.
Yes.
From existing Blackstone fund to another Blackstone fund, which gives a lot of confidence to the company that for the next, I would say 3 to 5 years period from now, there is a lot of stability in the company. So I don't foresee any changes that that will happen at the management.
Sure. All right, Rishi, we'll leave it on that note. Thanks very much. It helps clarify that aspect of management stability. So you're around till FY27 for sure. But there's no denial also on Mr. Saha. So we'll wait by and see how things develop. Well, let's quickly move on and address the sugar story again, because the sugar stocks are really, really charged up because the government has taken the decision to now allow a free use of sugar, sugarcane juice, molasses of all variety for the production of ethanol. Deepak Balani, DG at Indian Sugar and Bioenergy Manufacturers Association, and Atul Chaturvedi, Executive Chairman of Sri Renuka, join in to give us some perspective on this. Mr. Chaturvedi, morning, sir, and morning to Deepak as well. Let me open with you, Mr. Chaturvedi. Just tell us what this means in terms of the expected production. I mean, it was supposed to be, I think, a pretty good year for production overall. But now with sugar and molasses being diverted towards ethanol, first of all, do you foresee a lot of diversion? And what will that mean for the price and demand supply dynamics?
No, very, very good morning to you. In fact, last year's crop, which is going to be ending sometime in October now, was practically a disaster, something like about 29 or 29.5 million tons at the gross level. This year's rain gods have been very, very kind to India, and now it seems a little more kind than what we were expecting. We feel, and the whole industry feels, that the production this year is going to be rebounding big time. In fact, ISMA, which Mr. Balani represents, is now estimating that the crop overall could be anywhere between 34 to 35 million tons. And if that happens, there's no reason why diversion of sugar to ethanol, which current year is about 3.2 million tons, should not go up to anywhere between 4.5 to 5 million tons. And the sugar industry is quite capable of supplying to the government. The only request from the industry is that for far too long, we have been denied a price increase, and there's no reason why from maize, they continue to buy at around 72 rupees, closer to that, and from cane juice at around 65. So that is something which the industry has been demanding. And hopefully, the government will this year have the right kind of confidence to take the price up.
Right. And that's a question that we will just come to. But for now, what the government has done, what is the effect? The effect is it keeps sugar prices stable. On one hand, it keeps sugar prices stable and not too much, not excess supply of sugar in the market. And of course, I mean, you'll be able to sell more ethanol, which gets absorbed now. Is that the effect, Mr. Chaturvedi, for the industry?
Just look at our numbers. In fact, Indian consumption story is closer to about 28 million tons. And this year, if the production is going to be anywhere between 34 to 35 million tons, plus the carryover, there's no fear as far as sugar inflation is concerned. And to add to that, even if the sugar prices go up a little, there's no fear because our Prime Minister has also been saying that the sugar consumption and the edible oil consumption needs to be moderated. And in Indian context, higher prices definitely help in moderating consumption.
My question was not, Mr. Chaturvedi, I was not suggesting that there is a risk for sugar inflation. I was just saying that the effect is, the reason why markets seem to be excited is the fact that, I mean, there is an avenue for this excess sugar production. This year's crop plus last year's carry. That you agree with, right?
No, the last year's carry is going to be much lower than what was anticipated. And secondly, because the crop actually came down to about 26 or 26.2 million tons or thereabouts in sugar terms. So the carry out is going to be relatively lower. So we do not fear any sugar-related inflation as far as India is concerned.
Let's bring in Mr. Balani. Okay, so let's bring in Mr. Balani on exactly some of these points. Mr. Balani, you tell us, what was the, I don't remember exactly the numbers, but I don't remember, if you could just remind us, what was the opening stock? And now, as Mr. Chaturvedi is saying, that this year the production is going to be maybe 32 to 34 million tons. What happens to pricing as we enter the festive season? Earlier, perhaps there could have been a fear of some sort of a oversupply, not glut, but at least oversupply that could have been, pushing prices down. What happens now? Are millers hoping or expecting any price increase this festive season?
Yeah, hi. So we opened the stock of current season with around 8 million tons. And
okay.
Mr. Chaturvedi just mentioned, with around 28 million of consumption, we are hopefully will be closing the season with around 5.2 million tons. Having said that, the next year crops looks very good, and our estimate, the first estimate, is around 35 million tons.
Ooh, so 40 million tons. We're talking 40 million tons then. 35 plus the carryover from last year, if it's not been used.
Yes. So that 35 million ton is also with an upward bias. And we will also be coming out with our second estimate on 11th of September. And the news is that the rain gods have been very kind. And we are getting very consistent monsoon rains in Maharashtra.
So what about pricing? Absolutely, sir. Rain gods have been very, very benign this year. What about pricing now? Just help us understand this.
See, the domestic prices have been consistent. So, way back in last December, we've seen the domestic prices going way below the cost of production. But because of the export decision which was given by government in January, the domestic prices saw an upward, corrected movement. And we are seeing a stable prices in an anticipation of much better crop and much better sugar production next year. Even though we have around 5 million as a closing stock, I don't see that the market will go higher from here. It may go by 50 rupees, 100 rupees maximum. But I don't see it going very high because of the next year sugar production, which is going to be very good.
Okay, all right. Before we let you all go, gentlemen, Mr. Chaturvedi, just one final question to you. Since these restrictions on ethanol production have come off now, initially, what was the target that you were looking at in terms of ethanol production for FY26? And has that changed a little bit? Will you be looking at upping that guidance?
Let me correct the picture. The ethanol production in the country was not restricted this year. In fact, it was only in 2023-24 that the restrictions were placed on diversion of cane juice into ethanol.
Yes.
Because the government at that point of time was fearing a massive drop in sugar production. So I think overall we feel that the ethanol from the industry should be closer to about 5 million tons this year. 5 billion tons, yeah. So that should be and as far as Renuka is concerned, obviously we are one of the large ethanol producers, so it should help better capacity utilization as far as our...
Give us a number, sir, for Sri Renuka Industries. How much? What will the ethanol production be for this year?
Ethanol production next year, we anticipate it could be higher than 20 million tons as far as Renuka is concerned.
Okay. And so final point, and Mr. Chaturvedi touched upon it briefly, that pricing is very important. For ethanol production to be commercially viable for sugar mills, it's all about pricing. So, Mr. Balani, weigh in on this. As an industry body, what would you be asking for in terms of any increase when it comes to whichever category of molasses, I mean, B, C, juice, etc. As this 5 million tons moves towards ethanol production?
Yeah, see, it is very important for the government to maintain a balance of sugar stocks. Since we are going to have a much better production, it is very important that the diversion of almost 5 million tons is to be done so that we have balanced stock. We don't have a surplus stock because we don't want to see the domestic market crashing. At the moment, we also look forward for announcement of certain exports of sugar to maintain a balanced stock. So maybe start with 1 million in October so that the companies, the mills could also plan the raw sugar production.
And the pricing, sir, what pricing would you seek for, molasses?
Yeah, for the ethanol, see, as Mr. Chaturvedi said, it's almost 3 years. Our prices have not been corrected in spite of the fact that the FRP has gone up by almost 17%. And our cost of production for juice is almost 71 rupees. So we at least expect the government to correct the price of juice to around 71, 72 at the level of the maize ethanol prices. And also the B to almost 66 rupees, which is just the cost of increase in raw material, which is the sugar cane. So I think we are very hopeful because this is very, very important aspect to maintain the viability of the mills and also to make sure that the mills are able to pay to the farmers on time.
Yeah, 666 to 71 rupees, depending on the different categories of molasses and juice.
It's been a long-standing demand. So thank you very much, Mr. Balani and Mr. Chaturvedi, for joining us and running us through all those details. We'll take a quick commercial break here. Technicals in focus. Rahul Sharma, Director and Head Technical and Derivatives at JM Financial, will be joining us on the other side. Stay tuned.
Welcome back. Well, markets doing quite well. We are virtually at the high point of the day and we're holding above the resistance mark of around 24,700, which is good. And a stock that we highlighted in our morning chat, Mobikwik, well, that's up close to 9%, a rank underperformer. It's finding its way back today post the large trade that took place yesterday. So Mobikwik should come up for you on the screen. Now up, I think, close to around 10% after correcting close to around 60% from the top. Rahul Sharma, Director and Head Technical as well as Derivatives at JM Financial Services, joins us on the show. Hi, Rahul. Good to have you on the show. Well, rollovers are relatively higher this time around, and I think you've done some analysis on that. We have the FIs at a net short, and the hope is we see a reversal. Do you think we're due for one?
Yeah, very good morning, Nigel. So in the last 2 years, 2 to 3 years, it has happened that every time Nifty has seen a very high roller of, say, 84%, 83, 84%, the subsequent series has been one where reversals have taken place. Now, this happened the most recently in the expiry of March. So we saw March where there was volatility. Initially, the month began on a bumpy note. And then we saw a very big rally of around 1,500, 1,600 points happening in the month, in the series of March. Now, this time around as well, at least as far as the first 3 trading sessions are concerned, post the previous month's expiry that we have seen, Nifty has sustained the crucial support level of 24,300. Now, there is a very high possibility that this series, which means the September series, could be the month where we see a proper reversal of sorts, at least in the short to medium term. Now, what that translates is we have a very aggressive, bearish ratio, long short ratio by FIs. We had a market breadth which was dwindling by the day, and essentially a market which is oversold on most of the parameters that we've seen. So any trigger, whether it could be fundamental coming from the US or it could be something that probably forces FIs to cut their shorts, that would mean a significant rally can happen from these levels. So there are 2 cases possible. Either Nifty reverses from here itself. We've sort of, last 3 days somehow sustained 24,300, not broken that. Or alternatively, in case we do breach 24,300 on the downside, then 24,000 is the so-called base for the current series, which means buy on dip is something that we advise to our clients. And a essentially, from a sentiment perspective as well, we feel that the markets have hit a recent low, and the risk reward especially is favorable for a short covering rally from here. So September, we are putting our mouth where essentially we are calling that this could be a month where we could see a proper reversal of sorts.
Rahul, just a quick word on the flashes which is important. The Scott Bessent comments, which we are flashing at the bottom of the screen. And this kind of ties in with what we've been saying since the morning, which is that first, that Trump Truth Social comments seemed a little less confrontational, less aggressive in its tone. And now you have Scott Bessent, Treasury Secretary, who's always among the sort of top trade negotiators in the US. I mean, I think he's the most reasonable one. But this is what he's saying. I guess he was asked about the SCO meet in China between Prime Minister Modi and President Xi and President Putin. And he said that SCO is a long-standing meeting and largely performative. And it goes on to say India is the most, I don't know if we have the graphics, India is the most populous democracy in the world. At the end of the day, their values are much closer. Okay, I'll come back to this once we have the graphics. But these are, and let's have the flashes back on, please. Rahul is still with us. Rahul, so you're saying just in terms of direction of travel in the near to medium term, more up than down? That's your thinking?
Yes, absolutely. In fact, today's session, it is indicating that, we might very much test the 20-day exponential moving average, which is around the 24,800 area. So in the very short term, anything about 24,800 closing above that should bring in some positive momentum on the markets. And alternatively, even if we slightly zoom out a bit, I think 24,300, 24,000 is the area where you should be looking to buy the dip in case that happens. So, this is the time to cherry pick your stocks, probably start getting into setups which are relatively doing well, and be more long than short in this kind of a market.
Those flashes are at the bottom of the screen. That's the key part. He's saying essentially that India is the most populous democracy in the world. At the end of the day, their values are much closer to ours than to China's or to Russia's. And I think at the end of the day, India and US will get this solved. So I think he said this, once earlier, recently in the last three or four sessions, that at the end of the day, I'm sure it'll get done. There was a Fox interview, but I think this is now in the light of what's, of course, happening in China. And I think these are important comments to take note of. Adds to, of course, what we heard from President Trump yesterday as well. I mean, it's these tariffs, at least, especially the 25% tariffs. If that gets resolved, I mean, I think that gives a big boost immediately from a market standpoint. But you still will be left with 25% more. But that's kind of more normal, and you're done away with these 25%. If it comes to that, we'll see how this goes. But I think you're starting to see de-escalatory kind of comments and voices, etc., from the US side. Rahul, in terms of specific trades, what would you recommend in terms of positional trades from here?
Yeah, so two stocks are looking very good on this, medium-term charts. One is Dixon Tech. Yesterday, we saw a very strong volume-based activity in the same, a big cup and handle formation on the last 3 to 4 months is the pattern where this has been formed. We feel that the stock is, set to hit targets of around 18,500 to even possibly 19,000 on the upside. So this could be one stock which can do very well from these levels. Apart from that, there is a reversal of sorts on the two-wheeler auto space, especially in Bajaj Auto. Now, Bajaj Auto has been the only stock which is underperformed this auto space in a very big way. Now, yesterday's session, we saw a breakout happening above the 8,800 mark. And positionally, we feel that the stock has got long legs all the way up to 9,800 to 10,000 on the upside. So this is one stock that can be considered for a catch-up rally to be had in the auto space. And lastly, on the banking pack, RBL Bank is something that we like at these levels. The stock has defied gravity, stayed above its 20-day EMA. The stock is actually forming a bullish Poland flag pattern on the daily charts. And this is, in an environment where essentially Bank Nifty has taken a beating over the last few weeks. So positionally, we feel 300 is very much on the cards for RBL Bank. One can look to buy at these levels. maybe have a stop loss placed at 255 to 60 range, or look at bull spread in the same. So these are the top three stocks which we like on the long side, and they have a very good setup in terms of the medium term charts.
Dixon, RBL Bank, and Exide. Right, Rahul?
Absolutely, Nigel.
All right, Rahul, good to hear your thoughts. And going against the trend, expecting a good September. Hopefully by the time we end September, the Bears will be singing "Wake Me Up" only when September ends. Thanks a lot for joining in, Rahul, and giving us that view. For the time being, markets taking note at the high point of the day. Slip into a short break, come back. We'll continue to focus on stocks that are moving around.
The markets moved in, an up mode once again, 0.5% up on the Nifty. There's a 100-point rally now, and it's a little broader than just Reliance. So it's again turning out to be a decent morning, very decent morning so far. Let's shift the focus to commodities now. We have Manisha joining in. Manisha, yesterday, I remember this time it was all about the sparkle of precious metals. What are you tracking today?
Well, yesterday was more about silver because we saw newer highs come in for this one. Today is all about gold because, gold had hit all-time highs in the Indian markets. But overnight, we've seen gold prices hit all-time highs in dollar terms and various other currencies as well. So this is where the focus clearly lies now. So we're trading at all-time highs and we have seen $3,508 an ounce of an all-time high in the Asian markets right now. The last previous all-time high was in the month of April 2025 when the gold prices hit $3,500 an ounce. So we have seen stronger gains continuing for this one. We are looking at nearly 33% of gains for the gold prices till time. And there are various reasons on why gold really seems to be doing well at this point. One, it really has been about the safe haven buying that you have seen come in for gold. And this is after uncertainty because of the U.S. trade tariffs. As of now, yes, there are appeals court which is looking at the U.S. tariffs, but we have time till mid-October. Until then, it is going to be quite a choppy market. The second point really is about the dollar index, which is trading at a one-month lows, in turn providing support to the gold prices. The third thing is the markets will be watching out for the U.S. non-farm payroll data that comes in on Friday. The markets also are pricing in an 88% probability of a U.S. Fed rate cut in the month of September. There could be 2 or 3 is what the markets really seem to be talking about. But this is something that seems to be getting baked into the prices at this point in time. And then it has been about strong investment demand coming in from various countries. Chinese buying has been quite strong, whether it is from its pension funds, central bank, and the Chinese gold imports via Hong Kong also saw a jump of around 126% on a month-on-month basis for the month of July. August is expected to be on the stronger side as well. And then you have Vietnam, which is the third largest gold consumer in the Asian markets, and it has licensed commercial banks which are eligible now to produce, trade and manage gold bars. So there is more opening up that we see in sense of gold. Also, when you look at the last 1 year, there has been more gold buying than treasury buying by various global central banks. And that's something that the street is keeping an eye on. This is one thing that I want to keep in front of you. This is the production and the consumption global data when it comes to gold. 23, 24 and 25. This is an estimate, of course. But as you can see, the gold production is higher than the consumption in all of these last 3 years. So if you want to go by the supply-demand data, there's not so much of supporting for gold. But this is something that the gold doesn't always follow. Mining supply for gold, recycling gold of what's happening in the international markets are some of the figures that street does not pay attention on. So as I said, production is higher and the gold consumption is lower. But even with that, when you look at the last 3 years, we have seen the gold prices continue to gain. 15% up in 23, 21.5% in the previous year, and the current year has seen 33% of gains come in for the gold prices there. Interestingly, when you look at the central bank buying, that continues to be very, very strong. It was an all-time high buying at 1,082 tons in 2022. And since then, we have seen central bank buying quite consistent above 1,000 tons there. This year as well, lesser than what we've seen in last 3 years, but 1,000 tons of central bank buying is perhaps on target here as well. And this is about global banks. When you look at RBI as well, the last financial year, the last calendar year, we've seen stronger numbers coming in from RBI also. The Reserve Bank of India started buying in 2017 and since then has been buying every single year. The last plate should come in on your screens, which tells you on the gold share in the Indian forex reserves. It used to be 6.9% in 2021, has doubled by the time it's 2024 at 11.3%. And remember, RBI is buying this year as well. So if banks are buying and investors are buying, retail investments can't be far away.
All right, Manisha, thank you very much for that. I wonder how much space does 1,000 tons of gold occupy? Is it a room? Is it a small space, Manisha? 1,050 tons last few
Huge
years,
vaults,
1,000 plus.
I'm guessing the kinds you
vaults.
see in the Bond movies. Vaults.
Okay, all right. Yeah, absolutely. Let's take that break. It's our special segment. It's the economy. Lata in conversation with Nikhil Gupta of CLSA with his thoughts on where we stand as an economy. Lots happening. GST meeting tomorrow and beyond. So we'll talk through all of that in just a bit.
Welcome to It's the Economy. Today we're going to discuss something we discuss very little, the balance sheets of Indian households. Now, CLSA's economist Nikhil Gupta has put out a rather important, well-researched report pointing to a difficult development in India's household finances. He says since 2010, personal income growth in India is slower than personal consumption growth. Personal income since FY21 is growing at a CAGR, compounded annual rate, of 10%, but consumption is growing at 10.6%. This has led to households drawing down their savings and increasing debt. And this is now showing up in the form of slow FMCG sales, higher retail unsecured loan NPAs for banks. To understand more about this very little discussed problem, we are joined by the author of the report himself, Nikhil Gupta, the India economist at CLSA. Nikhil, good morning and thank you very much for joining me. I, of course, summarized it in a sentence. Can you tell me what is your real worry about Indian household finances getting weaker?
Good morning, Lata. Thank you very much for having me on the show. So as you mentioned, Lata, what we are highlighting is when we talk about household finances, there are various segments that we need to be aware of. Of course, at the center of the entire household finances lies the income growth. Then we look at the spending patterns. We also need to be aware of savings and borrowings distribution, as well as the financial balance sheet. That is all what we have discussed in this note. Now, over the past 10 to 15 years, what has happened is consumption growth of household sector has outpaced income growth. Okay. Now, if your spending growth is more than your income growth, it can happen only and only if you are drawing down or saving less, if you're drawing down your savings or you're saving less, and if you're adding more to your leverage. Both of these trends have been true in case of India. Household savings, total savings according to our estimates, was at 27-year low in FY25, and household debt at 55% of income or 43% of GDP was at all-time high. Now, the issue is, when we started this trend of consumption growth outpacing income growth, when it started, we had a very high level of a very comfortable level of savings, and our household debt to GDP or household debt to income ratio was very low. So when we started, it was not a problem. But when this has continued for 10 to 12 to 15 years, now we believe we have reached a stage where this kind of outpacing consumption growth over income growth is unsustainable. And this is very clear over the last 2 years. So what we have seen over the last 2 years is debt growth has come off, which started when the RBI proactively started putting constraints on unsecured loan growth. And we have also seen a reversal in the net financial savings. So net financial savings of households was at 47-year low of less than 5% of GDP in FY23. And now in FY25, 2 years, for the second consecutive year, we saw a recovery in NFS to almost 6% of GDP. Now, if these trends continue, we hope these trends continue over the next few years as well, by which I mean debt growth remained constrained and net financial savings continue to improve, then unless income growth picks up, it is very difficult for consumption growth to be anywhere close to what we have seen in the last 5 or 10 or 15 years. And that is where our concern comes in.
No, the point is taken. We're running your table of income growth in the various decades, and clearly one can see that personal disposable income, what we are discussing as income is PDI. It's available in the MOSPI website as personal disposable income. Now, Nikhil, while that point is taken that income is growing slower than consumption, if you actually look at the PFCE, personal final consumption data in the GDP, it was very bad in FY24. I agree with you. It was 5.6% or something. But last year, FY25, it was like 7.2. The number that came earlier this week, last week, was 7%. That consumption is not looking bad.
Right, Lata, when we talk about GDP from expenditure side or from PFC, GFC investment side, we must always remember that we do not have very robust data. we get GDP data from the GVA or the value addition approach. That is why there is no concern on the headline GDP. But when we talk about the components of GDP from expenditure side, especially on a quarterly basis or 1 or 2 years, we have to be more cautious because the share of discrepancies can be much, much higher. And we know it has been very high over the last 2 to 3 years. In one of the years, it accounted for as much as 50% of GDP growth, real GDP growth. And that is why I always speak about these, especially PFC. When we talk about this from GDP data, we have to be extremely cautious. It is very likely that these numbers will be revised. And since we have not had a base revision for a long time, that would also have an impact on PFC. We do not know how the surveys that were used in 2011-12 base to arrive at the unorganized sector has changed, not only in the last 15 years, but especially after the pandemic. So I'm hoping when we get the new base next year, early next year, we will see much probably slower growth in PFC in 25. And hopefully we will have much better understanding of where the consumption growth or household spending has been doing.
Yeah, I take your point. We are all waiting for February 2026 when the MOSPI has announced that they will give us the new series. Now, anyway, the most newsy part is the 7.8% GDP. We have news from the NSO that not everything is current prices deflated. Some of it is actual constant prices, agricultural produce, mining, metals, electricity. They have the constant volume growth. So to say that everything is because of a low deflator is not working. 7.8 is a good number. It is not looking like a country troubled by consumption.
You're right. So if you look at the breakup of GVA, Lata, which is the basis for GDP growth, there are definitely some portions which are available in both constant terms and current prices. So we cannot blame GVA deflator or lower inflation that has boosted real indicators of those segments. But our calculation suggests that almost 45% of GVA, which primarily includes manufacturing, trade and transport, and public administration and defense, these three big segments, all these segments are first available on nominal basis, and then WPI heavy deflator is used to arrive at real. And it is not a surprise that all these three segments have actually surprised on the higher side in first quarter of FY26 when the number was much higher than what we were expecting and what the general consensus was. So definitely this deflator has played a role. I mean, we have seen private final consumption expenditure, as you mentioned, doing much better in real terms, not as good as it was in Q4, but if you look at trade and transport. So deflator has played a role. I am totally in line with the fact that not 100% of data is first available in nominal terms and then we arrive at real using deflator. But all these three big segments which have surprised us on the upside, I think deflator has played an important role.
Okay, got it. No, that part, I looked up the NSO worksheet, and as you say, those items are first arrived at, from the BSE, NSE corporates and then deflated. Okay, let me come to your worry that, people are taking more loans and consuming, and that is the problem with households. Can that not be seen positively? We have not reached organized formal sector credit to many sections. Now, because of fintechs, NBFCs, Jan-Dhan accounts, we are able to give credit to larger sections. That is why borrowing has increased. As consumption increases, more production will happen. Consumption-driven growth can come, isn't it? Why should we worry about it so much?
What you're saying is possible, Lata. Now, as an economist, when I look at the macro or aggregate numbers, I do not have the details to be aware of what is the income profile of the borrowers that are there, how much loans have one borrower taken. And that is why I look at what the regulators are highlighting through their various surveys and what they are doing via their actions. So what we know for sure is that almost 2 years ago, the RBI started highlighting some concerns on the unsecured debt growth. Since when, we know that unsecured consumption-based loans growth has come off. It used to be in excess of 25% before September 23, September 23, when the RBI came out with these measures. And since then, our calculation suggests that it has now come off to 14 to 15% as of March 2025. Now, 14 to 15% is definitely much lower than what it used to be a couple of years ago, but it is still much higher than the income growth. And it is still the fastest growing segment within the household debt, except gold loans, which is still a very small portion. Right. So we do not, I mean, it is almost impossible for an economist like me who is sitting on the outside and do not have disaggregated data to know whether we have reached the inflection point, what is the income profile. Without that data, it is almost impossible to answer the question you're asking.
Yeah, we are getting the personal income with a lag. So, yeah, we are not able to identify whether income is also grown at the same time.
It is very clear. Income growth, even it has picked up. It has never picked. It has not picked up to 14-15%. I mean, it was close to 10% the last year. We expected at best close to 10%. So it is still weaker than the
growth in consumption. Fair point.
My debt to income ratio is still going up.
Okay, let me try to quickly squeeze in. Do you think that there are two things which are going to help consumption? One is GST cuts and the other is low inflation. Should not that alleviate the problem? The households will be better off.
All right. I take your second point first. No inflation when you say. So we know that the primary factor for driving down headline inflation has been food inflation. Right. First, food inflation is very volatile. And second, food inflation may benefit the consumers of food, but the producers of food, which is a rural segment of the agriculture sector, it's a realization for them. So it is not necessarily true that lower food inflation is good for the economy. Especially if it's sustained, we can see some kind of stress in the agricultural sector. Second, now coming to your first point, you mentioned about GST cuts.
GST cuts.
Definitely, there is no doubt when the GST cuts come into place, we will see a boost to consumption. However, that is only one side of the story. We also need to know what would be the exact kind of stimulus that the government has given. What would be the fiscal cost of these GST cuts? What would happen to the compensation cess? Will this continue till October, till December, till March? Will the new 40% slab that they have told us, will that slab attract any further cesses, or will that be the maximum GST rate on any goods? Because if that is the case, there are a lot of motor vehicles at this point in time, and some of the same goods, or the demerit goods as we call them, they have a much higher rate than 40% at this point in time. So are we actually looking at lower GST rates on those items? Is the government sacrifice in terms of GST receipts going to be a big kitty? How much will be the distribution between center and states? What kind of impact would it have on spending ability or spending growth of the government? All those questions need to be answered before we know the overall impact on the GDP growth.
Okay,
having said that, there is no doubt that from consumption perspective, GST cut is a positive thing.
Okay. Well, actually, I'm not going. I won't have time to concentrate on an important point that you have in your paper. That upper category, the K-shaped upper part of the economy is consuming very well. It is the lower part that is struggling. I don't have time to analyze that. But if you can quickly tell me this very important point you're making, that if the stock market were not to perform, the government also suffers a lot. We always thought that our household net worth goes down because we are invested in the market. But you're saying even the government will suffer if markets slip.
Right. So since we do not have time, I'll make it very short. What our analysis suggests is that almost the entire surge in personal income taxes that we have seen in the post-pandemic period. So we know that personal income taxes in FY19, FY20 was close to or less than 2.5% of GDP. It was 2.3% of GDP. And now we are at 3.7% of GDP. What we have done, we have looked at the contribution of equity market to personal income taxes collected by the government. And when I say equity market collection, we have three components. We look at the taxes on dividends, we look at the LTCG taxes, and STT, security transaction tax. Okay. When we look at the aggregate impact of these three items on PIT, we found that almost 90% of the surge in PIT from 2.3 to 3.7 is on account of these three factors, which is equity market contribution. If I exclude this equity market contribution, PIT is broadly closer to 2.5% in FY24, FY25, only slightly higher than in the pre-pandemic. And that is where we are highlighting that if equity market does not do good, if there is, let's say, 10-20% correction in equity market, it will not only hurt the household sector, household balance sheet, but it will also hurt the government tax collection, especially the personal income taxes, which has been the key driver of overall tax growth in the country in the post-pandemic period.
Okay, but it's good to know that the government is on your side. They want stock markets to do well. Thank you very much, Nikhil. I agree. It's a many-sided report and requires a lot more detailed reading and understanding. But thank you very much for giving us a jhalak of your report on household finances. Importantly, if the stock markets don't do well, then STT, LTCG, dividend tax, all these incomes also for the government go down. We have to remember that. Well, with that, we'll wrap up this edition of It's the Economy. After a break, it'll be time for Chartbusters.